क्या म्यूचुअल फंड्स सही है? The problem with mutual funds is that everyone keeps telling you that how much SIP you should do and how much money you will be able to make, but very few people understand that who creates these mutual funds, who sells them, and how are the players in the system paid. Because in finance, incentives matter more than intention. So the companies who manufacture mutual funds are companies like SBI, ICICI, HDFC. These are the companies who create these funds. There are two ways to invest in these mutual funds. Number one, regular plans, and number two, direct plans. Direct plans basically mean that you are buying the products directly from the manufacturer. In this, you do not pay any commission to any middleman involved because there isn't one. Now, in regular plans, there is a middleman who advises you on which funds to buy, what are the pros and cons of that particular mutual fund. Now, it is very important to understand that what are the incentives of this middleman. So this mutual fund distributor who advises you on what to buy, what to sell, actually gets a commission. So whatever lump sum investments or SIPs that you do, that mutual fund distributor gets a commission out of it. Usually on average, the mutual fund distributor gets around 0.7% of any amount that you invest. Now the problem with this is that the mutual fund distributor's best interest lies in you constantly investing in the markets. If you reduce your investments or withdraw money from the markets, the assets under management reduce and the commissions for that distributor also reduce at the same time. So you can clearly see that there is a conflict of interest. The higher the AUM, the higher would be the commissions for the distributor. So when the markets are rallying, you are already under an emotion of FOMO. You have seen your friends making money, you have seen your relatives making money. So then it is very easy for the distributor to increase your SIPs and increase your lump sum investments, which increases the overall assets under management and hence increases his commissions. And whenever the markets are falling, you often see that the story of buy the dips starts floating and you continue to increase your SIPs, or if not increase, at least you continue to maintain your SIPs. So the ecosystem is designed in a way where there will always be some conflict of interest. So what's the solution for this? SEBI registered investment advisors are one solution who charge a flat fee and are able to give conflict-free advice to you. But in a country of around 10-15 crore demat accounts, there are only 1,000 odd registered investment advisors out there. That's a really low number. But why does that happen? So the investment advisors basically charge a flat fee of say 15,000 or 20,000 per year, and there are very few Indians who are willing to pay this. The reason for this is because they often feel that the mutual fund distributor that is giving him advice is some kind of free advice. But is it really free? Let's see an example. So if you have 20 lakhs worth of assets and the mutual fund distributor earns around 0.7% on these 20 lakhs, he's basically still charging you 14,000 rupees annually. Now, this is not a direct charge that you can see that you are paying, but indirectly you are paying it to the mutual fund distributor for advice. So technically, even if you go for a 15,000 investment advisor, the fees would be pretty much the same, right? But in one case, there are a lot of conflict of interest. And in another case, there is relatively more transparency and authenticity. Let's see a few scenarios where the mutual fund distributor and the investment advisor would act differently based on their incentives. The markets have had a great run. The markets are at the peak, almost at the all-time high. Most of the stocks are overvalued. Now, it makes sense for you to reduce your equity exposure. Suppose you have 60% of your overall net worth in equities. It makes sense to reduce that 60% to at least 40% or 45%. Now, the mutual fund distributor, will he advise you to start selling your equity mutual funds and move to maybe debt or gold? Maybe yes or maybe not, because it goes against his incentives. If you start selling your equity mutual funds, his AUM reduces and so does his commission. So he's basically losing money if he suggests you to start selling your equity mutual funds and start investing in debt funds. On the other hand, an investment advisor has already charged you 15,000. So it doesn't matter to him whether he suggests you to buy equity mutual funds or buy debt mutual funds or buy gold ETFs. He will basically want to suggest you that is in the best interest for you, because that is his incentive. If he performs well this year, in the next year you will again hire him and pay the flat fee. So he analyzes the condition, your condition and the market's condition, and thinks that maybe the equity markets are quite overvalued, and he suggests you to reduce your exposure from equity and increase your exposure at debt or gold. Let's take the second scenario. Suppose you want to buy a car 3 years down the line. Now the mutual fund distributor might ask you to start an SIP for this goal. But the question is, where is he asking you to put your money? If he's suggesting you an equity mutual fund for a goal which is just 3 years away, it is a really bad decision, Because what if the markets fall 20% in the next 3 years or 25% in the next 3 years? Clearly, you won't be able to achieve your goal. And the second bad thing that will happen to you is you will sell your mutual funds at a really bad price. On the other hand, an investment advisor will most likely ask you to save for this goal through a debt fund. At least your capital would be preserved in this case. Even if this means that you have to do a higher monthly SIP, at least your purpose, your goal is being fulfilled in this case. Let's go to the third scenario now. The markets are near the all-time high. Either they can break the all-time high and keep rallying, or they can correct sharply from here. The best thing to do would be to wait for some time to see what the markets are doing. But let's see, what does waiting mean for a mutual fund distributor and an investment advisor. So if a mutual fund distributor asks all his clients to stop the SIP for the next 3 months, he's basically making his SIP book zero for the next 3 months. So which basically means that he's giving up on his earnings for the next 3 months. That's quite unlikely, right? Most people won't do that. Whereas an investment advisor would ask you to wait. He would ask you to continue your SIP in a liquid fund, and when the time is right, he would suggest you to move all those funds to the equity funds. Since the investment advisor doesn't earn any commissions on you buying liquid funds or equity funds or whatever, he has already earned his 15,000. So it is very easy for him to ask you to just wait for some time and see how the markets are reacting. Let's try to understand this structure with a very good example. Let's compare it with pharma companies. So a pharmaceutical company which is making medicines. You can equate the mutual fund manufacturers such as ICICI, HDFC and SBI to this pharmaceutical manufacturers. These are the people who are making the medicines or creating the mutual funds. Then these pharmaceutical companies distribute these medicines through chemist. The chemist has good knowledge about the medicine. It knows what the pros of the medicine are, and it also knows what the cons of the medicine are. You can equate this to the mutual fund distributors. They know what the product is, they know what the pros and cons of that mutual fund are, and they are basically distributors of that particular mutual fund. Now, whenever you are sick, you just don't go to the chemist and ask him that which medicine should I take, right? You first go to a doctor and ask him that what my condition is and what medicine should I buy. Investment advisors are basically doctors of this industry. They analyze your overall situation, your overall financial condition, your cash flows, your future cash flows, and then they suggest a very holistic plan and suggest you on which medicines to take, or rather which mutual funds to buy, where to invest. So rather than jumping into mutual funds, it is very important to understand that who is the one who's giving us advice, what are the incentives behind that advice, and how will it align with your incentives. In the next video, we'll start with equity mutual funds and try to understand what type of different funds exist over there. Thanks for listening.